Hi guys, so welcome to part 2 of how to build a winning ETF portfolio. So in the previous video, we talked about the different types of ETFs available. You've got ETFs you can buy that track stock indices, right? So for example, the entire stock market index, like the S&P 500, the Dow Jones. You've got sector or industry ETFs that track a specific sector or industry equity index. You have got bond ETFs, you have got foreign currency ETFs, commodity ETFs, and exotic ETFs like inverse and leverage ETFs. So the question would be, all right, so which ETFs do I buy? Now, first of all, we have to understand that all these ETFs, they move in different cycles. So if you take a look at a couple of charts, this is the SPY, which is the S&P 500 ETF over a 7-year period. So as you know, the stock market goes through downtrends, like during the global financial crisis, and uptrends during a recovery phase. So that's a SPY. Now over that same period, this is what happened to the bond market. So this is the TLT, which is the bond ETF, the 20-year Treasury bond ETF that tracks Treasury bonds or government bonds. And over that same period, you can see that bonds appreciated in a pretty clear uptrend, because even in the global financial crisis, the government would still pay out on their bonds. So you didn't have that downtrend on bonds, so to speak. This would be the IEI, and this is the 3 to 7 year Treasury bond ETF, which again has a pretty clear uptrend over that same period of time. Next, we have the GLD. And the GLD is the gold ETF. So again, there are many commodity ETFs, silver, oil, and gold. And I've just picked gold because it's one of the most common commodities that people invest in, because they feel that gold is a safe haven. Whenever there's a threat of war or crisis, people buy gold. At the same time, gold is a hedge on inflation. Whenever there's inflation and the currency, the US dollar goes down, gold goes up. So it's kind of like a hedge against the depreciation of the US dollar, all right, when it happens. So you can see, for example, in this period over here, from 07 to 2012, gold was on a very strong uptrend because the Federal Reserve was cutting interest rates. And that causes inflation, that causes the US dollar to go down and gold goes up. Now, what happened over here in late 2011? They decided to stop printing money. They decided to stop cutting interest rates. In fact, they started raising interest rates and stopped the QE, quantitative easing program. So that caused the US dollar to go up, to firm strengthen, and ever since then, gold has been on a downtrend. Finally, we have got the DBC, and the DBC is an ETF that tracks a basket of many commodities. Silver, gold, oil, soybeans, sugar, cocoa, coffee, and so on and so forth. And as I've mentioned in the previous video, if you look at commodities as a whole, they make a lousy long-term investment, because if you bought the DBC in 2007 over here, right, and you held it for 7 years, guess what? You would have been breaking even or losing money. So repeat, commodities are a very lousy long-term investment, but they are good to put in your portfolio to hedge against your stock portfolio at times. So in other words, when the stock market goes down, like for example over here, from October 07 to 2009, the stock market collapsed, but commodities went up in a straight line. Oil went up, gold went up. All right. So if you had both stocks and commodities, the increase in commodity prices would offset the loss in stocks, and you get a net gain. So commodities are a good addition to hedge a stock portfolio, but not as an investment by itself. But at the same time, commodities, you can make money in them as a trader. In other words, you trade the trends. You buy at the start of the uptrend. You must exit the moment the trend reverses. And you can also go short during a downtrend and profit as commodities collapse, like oil or gold. So if you put all these ETFs together, right, you get something like that. So over that 7-year period, this is, see the black one you see over here? This is the black one. That's the DBC, the commodities ETF. The green one is the gold ETF. The black one over here going down and then going up all the way here, that's the SPY, which represents the stock market, because the SPY is the S&P 500 ETF, right? You've got the blue one, which is the long-term bonds ETF, which is the TLT, which I talked about just now. And the one in brown is the short-term bond ETF, which is the IEI. All right, so notice something interesting. They move in different cycles, so if you hold a portfolio of all these assets, they tend to balance out. They tend to hedge against each other. When one goes down, the other goes up, you still make a net gain. For example, during the financial crisis, from 07 to 09, what went down? That's right, the stock market collapsed, right? So you see the SPY, which is the S&P 500, went all the way down, losing about 60% of its value at that point of time. But at that time, commodities, right, specifically oil and gold, went up, right? And green is gold by itself, went up as well, all right? As they cut interest rates, gold went up, all right? Bonds, which again is the one in brown and blue, went up steadily during the financial crisis. So in other words, if you held a portfolio of stocks and bonds and gold and other commodities, you'd find that during the financial crisis, the gain in commodities, the gain in gold, the gain in bonds would have offset the loss in stock. So you still make a net gain. On the other hand, if you take a look at 2012 to 2015, this was a time when the US economy was recovering, right? So they started to increase interest rates. They stopped printing money. So when that happened, gold collapsed, right? See, gold went all the way down. And oil started coming down because as the US dollar goes up, commodities come down, right? So gold was coming down, commodities was going down. But the stock market was roaring. The stock market was coming back, right? So the SPY went up. And again, bonds being, the safer ones, still went up, but pretty much very slowly sideways. So again, during this period, if you held a basket of all these assets, the gain in the stock market, the gain in bonds will have offset the decline in gold and other commodities, right? So in other words, how do you make money knowing this? So there are a few approaches. The first approach is called a multi-asset approach, which means you buy a percentage of all these commodities into one. And you just buy and you hold them through their ups and downs. So they kind of like balance off each other. That's one approach which I'll talk about in a short while. We call that buy and hold, and you can use dollar cost averaging to average your cost over a period of time, which makes it really safe. A second approach is to trend follow these specific assets and ETFs. So in other words, at any period of time, there's always something going on. At any period of time, there's always something going down. So in other words, in any period of time, you can always go long and make money on the asset going up. In this case, the stock market. And you can also make money by shorting or going short the asset which is going down, which is the gold ETF in this case. So when you do trend following over this period of time, what would you do? That's right, you would go long on SPY, right? You go long the SPY ETF, you go long on the bonds ETFs, like TLT and IEI. But you go short on DBC, which is the commodity ETF, you go short, and you go short on gold. So if you do that, you're basically making money every single way. But to do that, you have to read trends accurately. So I've got many videos on how to read trends in our professional stock trading course. We also teach you how to identify trends really accurately and how to identify reversals in trends. So let's take a closer look now at the two different approaches. So once again, the first approach would be to adopt a buy and hold multi-asset allocation strategy. In other words, if you got $100,000 or $10,000, you don't put everything into one asset class, like not everything into stocks or not everything into gold, because again, it could be on a downtrend. So that's the easiest way to do it. If you do not like to monitor the market closely every day, is to just buy and hold everything in a multi-asset portfolio. So for example, a suggestion could be where out of 100,000 or 10,000, 24% is allocated to stocks, right? And again, for stocks, you could buy US stocks, you could buy Taiwanese stocks, Hong Kong stocks, emerging market stocks using the ETFs. So in this case, you can see 24% is allocated to US stocks. And we use the SPY ETF as a way to gain exposure to the US stock market, right? 20% could go to international stock markets. So for that, I'll use the EEM. So the EEM is the Emerging Markets ETF. So this ETF basically buys into the stock markets of emerging markets like Poland, Chile, Indonesia, Malaysia, Brazil, Russia, India. All right, so that's 20%. So in other words, 44% is into stocks, half of which is into US, the other half emerging markets. Right, so it's 44%. 40% could go into TLT, and again, TLT is the bond ETF, long-term treasury bonds, to kind of like hedge the market, the stock market. All right, 8% could go into gold, all right, using the GLD ETF, and the remaining 8% into the DBC, which is a collection of many commodities, all right, oil, silver, gold, and sugar and coffee. So this makes it a very diversified portfolio over many asset classes. If you didn't get that, let me just write it down really clearly for you. So this is the US stocks. This represents emerging markets. Or rather, emerging stock markets. All right. This represents long-term bonds or long-term treasury bonds, 20-year treasury bonds issued by the US government. This is gold, represents the gold asset. And DBC will be commodities. And again, you can review this in my previous video when I talked about the different kind of commodities. All right. Excuse my handwriting. Okay, it's not easy to write with this, right? Okay, great. So once you allocate to that proportion, what you do is every year you have to rebalance your portfolio. What do you mean by rebalancing? That means at the end of every year, you have to sell some assets and buy some assets to maintain the same percentage allocation. All right. So for example, after a year, let's imagine that the S&P 500 went up, okay, in value. So from 24,000, it's worth 30,000, right? Emerging markets went up as well, from 20,000 to 26,000. But bonds came down slightly from 40 grand to 38 grand. Gold came down to 7 grand from 8 grand, and commodities went from 8 grand to 6 grand. So, but overall, you're still making money, right? So 100,000 becomes, example, 107,000. But what happens now? Notice that now US stocks account for 28% of your portfolio, because 30,000 of 107,000 is 28%. And now gold is only 6.5% and bonds is only 35.5%. So you still want to maintain this original percentage. So you have to rebalance it. So what does it mean? It means to say you have to sell some of your SPY ETF shares and then allocate them to the bond ETF. Right? Similarly, you sell some of the EEM shares and allocate them to the gold and DBC ETFs. So by doing that, you rebalance it. So out of your 107,000 capital or value of your account, 25,000 should actually be allocated to shares in this SPY. So you have to sell about 4,300 worth of this and reallocate to TLT to increase the percentage from 38,000 to 42,800. Right? So that's what we call rebalancing. If you do that consistently, you've got a very diversified, very safe portfolio. So this is one approach. So what's the best investment strategy? When's the best time to enter the market to buy shares, and when's the best time to exit and to sell shares? So there are two approaches. One approach involves not timing the market. It involves what we call dollar cost averaging. And the second approach involves timing the market through reading and following trends. So let me talk about the first approach. The first approach is perfect for people who don't like to monitor the markets regularly, or for some reason they don't like to look at charts, they don't like to read trends, all right? So it's kind of like an idiot approach, the first approach. And the first approach is dollar cost averaging. So this is a process where you invest a fixed dollar amount at regular intervals. Now, I must stress that for this to work, it must be a fixed dollar amount. For example, you decide to invest $10,000 or $100,000 or $1 million or $1,000, whatever it may be. But once you decide, you cannot change it. you have to fix it consistently. So let's imagine you invest $10,000 every 6 months at a regular interval. Again, it could be every 1 year or every quarter. Okay? And you invest in the portfolio of different assets, or you could simply just invest in the stock market if you want to be more aggressive. Now, if you do this, you are guaranteed to make money over the long term. Why? Well, let me show you the math behind it, the math behind it. Okay, so here's the S&P 500 over the last 20 years, and we know that in the long run, the index always goes up, right? Because of growth, technology, and inflation. But over the medium term, you've got these big volatile ups and downs in the markets, right? So again, you can time your entry, which is what I'll be talking about in trend following, or you could simply do a dollar cost averaging approach. So let's imagine you invest a fixed $10,000 every year for 20 years. Now again, if you do this, you're guaranteed to make money. Why? Let's see what happens. So initially, the market or the SPY is somewhere at $90, right, back in 1997. So you invest $10,000 worth of your money. So with $10,000, how many shares can you buy if each share is $90? Okay, or rather, in this case, $99, right? The answer is 100 shares. Okay, so let me just repeat that. If you invest $10,000 and the current price is $99, where it is here in 1997, you buy 100 shares. Okay. Now the next year in 1998, it goes higher, as you can see. So now the price of one share is $113. So what do? You invest the same fixed dollar amount. You invest $10,000. But now because the price is higher, you only buy 88 shares for the same $10,000 investment. In 1999, it goes even higher. So the price is now 139, and with 10 grand, you buy 72 shares. So notice what happens. As the price goes up, you're buying less and less shares for the same capital. Now, in the year 2000, it hits a peak over here. That's the top of the market, and you buy 65 shares, right? At $153. Now, in 2001, what happens? You can see the market collapses because of the dot-com bubble bursting. So in 2001, the price drops to $125. But you still invest $10,000. So now, with a lower price, you buy more shares, 80 shares. Okay? In 2002, it drops all the way to $91, even below where you started in 1997. But again, having the discipline to invest $10,000, you buy 109 shares. And you keep repeating this process, right? Every single year you do this, right? So again, if you do this, what happens? Notice that when the price is high, you buy less shares. And when the price is very low in 2002 and 2009, what happens? You buy more shares over here. Okay? And when it's at the top over here, 2007, you buy less shares. So what happens is it averages your price. So on average, what's your cost per share? So the total amount you invested is $10,000 times 20 years. That's $200,000. Okay, so $200,000 divided by the total number of shares that you bought. So if you add up all the shares you bought, it would be 1,583 shares. So 200,000 divided by 1,583, the answer would be 126.34 per share. So in other words, on average, over that period, you paid $126 per share, which is somewhere here. No, in fact, it's somewhere here, right? So this would be your average price, right? So you can see that as the market moves up over time and you're averaging, you're basically buying at the center. This guarantees you buy at the center of the market cycle. You will always make money over time. And this guarantees that you never buy at the top. So this is known as dollar cost averaging. So from dollar cost averaging, which is basically, again, buying at the average price over a long period of time. Let's move on to the second approach, which is my favorite approach. It's the approach that I use personally because I can make a lot of more money from it, but it takes more monitoring, it takes more skills, and that's known as trend following. All right. So markets, whether is it the gold market, the stock market, the bond market, they move in cycles, they move in trends, right? So the first thing that I do is I identify what is the trend of the market. Is it on an uptrend? Is it on a downtrend? Is it going sideways? And I identify trends using price action or wave patterns as well as moving averages. So the moment I determine that it's on an uptrend, I will go along. I will buy and I'll ride the trend up. If it's on a downtrend, either I don't buy or I will sell by doing a short sell. So I profit as the market comes down. So the first thing you have to do is to be able to identify trends. Okay. So I've got many other videos on identifying trends, and again in my professional stock trading course, I'll teach you how to identify long-term, medium-term, and short-term trends to make money really consistently. So over here you can see that the SPY S&P 500 ETF is on a clear uptrend. So how do you define an uptrend? An uptrend is defined by the price making higher highs, a series of higher highs, and a series of higher lows. That's an uptrend. Okay, so whenever you see higher highs and higher lows, that's a good indication that you're on an uptrend. Okay, this is a period of time when the S&P was on a downtrend. How do you define a downtrend? Price is making lower highs and lower lows. So again, that's a very clear definition of a downtrend. Okay, and the general rule is this: when the price of an asset is on an uptrend, the statistical probability based on collective psychology is that prices will tend to move higher over time. So on an uptrend, you only want to buy, you only want to go long. Okay? When the market is on a downtrend, the statistical probability based on, again, collective psychology is that prices will go lower because the market's bearish. So you never ever want to buy, you never want to hold on a downtrend as a trend follower. In fact, you either stay out of the market or you do a short sell, so you profit as the price continues moving down. So again, one way is to read the price action patterns. Another way to read trends is simply by using moving averages. And again, if you watch my previous videos, I talk a lot about using the 50 and 150-day moving average to read the medium-term trend in the market. So the blue line is the 50 moving average, okay? And the green line is the 150 moving average. And again, you can use either the simple moving average or the exponential moving average. Doesn't make much of a difference in the medium term anyway, all right? So you can see over here, when the 50 moving average, the blue line is above the green line, it's on a very clear uptrend. That's a signal of an uptrend, okay? So whenever the 50 is above the 150, you want to go long, you want to buy, you want to stay long. When the 50 blue line, as you can see over here, crosses below the 150, and both moving averages are sloping down with the 50 below the 150, that's a clear downtrend. So that's the time when you want to sell and get out or short the market, okay? So let me again emphasize that the slope of the moving average is really important. When the 50 and 150 are sloping up, it's a clear uptrend. When they're both sloping down, it's a clear downtrend. So once you understand this, you know exactly when to enter and exit a specific ETF. So if you use trend following, for example, you would enter the SPY over here because the 50 crossed above the 150. And when you see the 50 sloping up and the 150 sloping up, the 50 above the 150, that's an uptrend, that's when you buy. So you buy somewhere over here. And now, would you have sold over here? No, because although the 50 crossed below the 150, but the 150, the green line was still sloping up. As long as one of the moving averages are sloping up, it is not a downtrend. Both moving averages have to be flat or sloping down to confirm a downtrend. So this would not have been a sell signal. Now over here, you can see the 50 crossing below the 150, and they are both sloping down. So that is a clear exit signal. So using trend following, you would have bought here at this price and sold here before the downtrend commence, right? So that would have been the S&P. So again, selling here, you would have gotten out of the market, right, before it went all the way down to $68, okay? And then again, you would wait for the 50 to cross back above the 150, the 50 sloping up, the green is sloping up, you would again buy over here, and again ride the trend up. And over here, you would sell, right? You would sell, and you take a nice profit over here. And over here, what do you do? That's right, you buy back in again. So you just follow the trend using the moving averages. And again, this only works for the indexes over the long term, okay? So that's the SPY. And again, you would have sold the SPY, bought the SPY, and let's look at gold, right? This is the gold ETF. So you can see that you could have bought gold over here, you could have bought gold over here, or over here. As long as the 50 is above the 150 and they're sloping up, it's a clear uptrend, and you can buy whenever it made a temporary dip on the uptrend, right? You could buy over here, over here, over here. And would you have sold over here? No, because you can see the 50 crossing below the 150, but the 150 sloping up. But you could have sold somewhere over here, right? This could have been a sell. This would be a buy. This would have been a buy. This would have been a buy. So you've taken a very nice profit over here. Okay. Now over here, this could have been a buy signal, right? Could have bought over here, right? But you would definitely have to sell somewhere over here. So obviously buying here and selling here, you would have made a slight loss. A slight loss, because you can't, sometimes trends can reverse very fast, you can make a loss. But again, the profit you have made on this would have been a lot more than the small loss on that, right? So that's how I perform trend following on different ETF asset classes. So I hope you've enjoyed this video, and again, there's a lot more to learn in the markets. If you'd like to learn more, you can come to our live training courses in Singapore, in Malaysia, in Vietnam, in the Philippines, in Indonesia, and you can check out our website at wealthacademyglobal.com. If you're anywhere else around the world, you'd like to enroll in our professional stock trading course, you can check out piranhaprofits.com. If you've got a question, you can send me an email. My email address is adam@akltg.com, right? That's America, Kilo, London, Tango, Golf.com. I'll be happy to answer your questions. So take care, guys, and I'll see you soon in the next video.